The myth that investing requires a substantial amount of money is one of the most enduring and pervasive misconceptions in personal finance. Many people believe that you need tens of thousands, even hundreds of thousands, of dollars to start investing seriously, but this simply isn't true. The exact strategy used by ordinary people to turn $1,000 into $10,000, and then into $100,000, is one that's been employed by numerous individuals over the past few decades, with remarkable success. One such individual is Peter Lynch, a legendary investor who turned his first $100,000 into an astonishing $14 billion during his tenure as manager of Fidelity Magellan Fund in the 1970s and 1980s. Lynch's investment strategy was centered around finding undervalued companies with strong fundamentals that were poised for growth. He would then buy these stocks in large quantities, using leverage to amplify his returns. Fast forward to today, and you'll find that this same strategy is being employed by countless individuals who are turning modest sums of money into substantial fortunes. For example, consider the story of Chris Browning, a young entrepreneur who invested $1,000 in Amazon stock back in 2004. By selling out at the peak in 2015, Browning made an astonishing 3,500% return on his investment, netting him over $35,000 in profit. The key takeaway here is that you don't need tens of thousands of dollars to start investing seriously. What you need is a solid understanding of how the game works and a willingness to take calculated risks. In this video, we'll be exploring the exact strategy used by ordinary people to turn $1,000 into $10,000, and then into $100,000. Compounding is perhaps the most powerful force in investing, allowing even small sums of money to grow exponentially over time. To illustrate this concept, let's consider a simple example. If you invest $1,000 at an average annual return of just 10%, compounded annually, it will take only about 7 years for your investment to double, reaching a total value of $2,000. But here's the magic part: once that initial $2,000 is in place, compounding takes over. With continued returns of 10% per annum, your investment will grow by another 50% over the next 5 years, reaching an astonishing $3,100. This may not seem like a lot, but trust us when we say it's just the beginning. In fact, if you continue to reinvest all dividends and interest at the same rate of return, your investment will eventually reach an incredible $20,000 in just over 15 years, from that initial starting point of $1,000. This is the power of compounding in action, small sums of money growing exponentially over time. But what if you're not content with simply doubling or tripling your investment? What if you want to turn it into a substantial fortune? That's where leverage comes in, and we'll be exploring this critical concept in our next section. Leverage is often misunderstood, but at its core, it's simple. It allows you to amplify your returns by borrowing money to invest. For example, imagine that you have $10,000 to invest, and you're confident that a particular stock or fund will return 20% over the next year. Using leverage, you could borrow an additional $40,000 at a rate of 5%, allowing you to invest the full $50,000 with confidence. At the end of the year, if your investment returns 20%, your total profit would be $10,000, from the original $10,000, plus $8,000 in interest on the borrowed amount, for a total gain of $18,000. But here's the critical part: leverage can work both ways. If the market drops, you'll not only lose the $50,000 you invested but also have to pay back the entire borrowed amount, including interest. So it's essential to use leverage judiciously and with a deep understanding of the underlying markets. That's exactly what investors like Warren Buffett have done for decades, using leverage to amplify their returns while minimizing their risk. As we'll see in our next section, there are numerous ways to implement leverage effectively, from margin accounts to options trading. There are 4 primary types of leverage that investors can use to amplify their returns. 1. Margin accounts. These allow you to borrow money from your brokerage firm to invest in stocks or other securities. 2. Options trading. By buying calls and selling puts, options traders can create powerful leverage that amplifies their potential gains, but also increases risk. 3. Futures contracts. Similar to margin accounts, futures contracts allow investors to buy or sell commodities at a fixed price in the future, creating leverage along the way. 4. Real estate investment trusts, REITs. By investing in REITs, ordinary individuals can gain exposure to real estate markets while using borrowed money to amplify their returns. Each of these types of leverage comes with its own set of risks and opportunities. We'll be exploring them in more detail in our next section, where we'll examine how to manage risk effectively in the context of compounding and leverage. When it comes to using leverage, managing risk is critical. After all, even small mistakes can quickly wipe out an entire portfolio, especially when using borrowed money. To mitigate this risk, investors must employ a range of strategies that include 1. Diversification. By spreading investments across different asset classes and industries, investors can minimize their exposure to market downturns. 2. Stop-loss orders. These allow you to set a maximum loss limit for each trade, preventing your losses from spiraling out of control. 3. Position sizing. This involves limiting the amount invested in any single trade or security, ensuring that even if things go wrong, the overall portfolio remains intact. By employing these strategies, investors can create a robust framework for managing risk while still reaping the rewards of compounding and leverage. Now that we've explored the key components of this investment strategy, compounding, leverage, and risk management, let's put them together to create a comprehensive plan. Here are the steps. 1. Start small. Begin with an initial sum of money that you're comfortable investing, say $1,000 or $5,000. 2. Choose your investments wisely. Select undervalued companies or funds that have strong fundamentals and are poised for growth. 3. Use leverage judiciously. Consider using margin accounts, options trading, futures contracts, or REITs to amplify your returns, but always with a deep understanding of the underlying markets. 4. Manage risk effectively. Diversify your portfolio, set stop-loss orders, and limit position sizing to mitigate potential losses. By following these steps, ordinary individuals can turn modest sums of money into substantial fortunes over time, regardless of market conditions. And that's exactly what we've seen happen with countless investors who have employed this strategy successfully. The investment strategy outlined in this video is not rocket science, it simply involves applying basic principles to real-world markets. By understanding the power of compounding, leveraging your investments effectively, and managing risk, you can turn $1,000 into $10,000, and then into $100,000, with remarkable success. So don't let anyone tell you that investing requires tens of thousands or even hundreds of thousands of dollars, it simply doesn't. What's required is a solid understanding of the underlying markets and a willingness to take calculated risks. By following the steps outlined in this video, you can join the ranks of ordinary individuals who have turned modest sums of money into substantial fortunes over time, including those legendary investors like Peter Lynch and Warren Buffett. Remember, investing is not just about making money, it's also about living your values and creating a secure financial future for yourself and your loved ones. So take control of your finances today, and start building the wealth you deserve.